Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest. We've got Bikran Sandhu. Bikran, appreciate you coming on the show.
Of course. Thanks for having me, Darin. Appreciate you guys, man.
Absolutely. So just a little bit on how we know each other. Myself, Bikran, and his two business partners, Zach and Robert, all four of us were part of the same multifamily mentorship group. We met probably about 5 years ago, and I've actually invested passively in a couple of their deals in Phoenix, and we recently started to partner on some deals in Dallas together. And so I really like these guys. I think that they've got a great company. They've got great momentum, and I'm interested to hear what they've got going on. So with that, Bikran, can you share a little bit with the listeners in terms of, how many properties, how many units, how you guys have grown through the past few years?
Yeah, of course. No, thanks again, Darin, for having me on here. And for those of you who don't know, I am a CFO and co-founder at Rise 48 Equity. I essentially co-founded the company with Zach Haptenstall and Robert Shevchik, my two partners in multifamily investing. So, through today, we started in 2019, and through today, we have 43 assets under management that we've acquired as general partners in the deals. All of them were the main partners, in those deals. And I have personally invested passively in 2 additional deals, one in Oklahoma and one in Texas. So for my personal balance sheet, I've invested in 45 deals in total over the past 5 years.
That's pretty amazing. I get some people that are like, yeah, I'm invested in 5 deals or 10 deals. And, even when it gets to like 20, it's like, that's a lot of deals to be invested in. But to be in 45 deals, that's pretty crazy. So the other thing that's crazy is the assets under management. So when you say 43 assets, you guys have gone full cycle on like, I think 10
11.
11. But you guys have a crazy amount of assets under management.
Yeah, no, we've so total number of units we've acquired is just over 7,600 units. I think the total purchase price has been around 1.95 billion. So it's been a fortunate and nice ride. And right now we have we've bought 43, we've sold 11, so we have 32 assets under management, 29 in Phoenix and 4 in Dallas, and we're continuing to expand in Dallas for the foreseeable future to kind of build out the market out there. It's been a good ride, and we've kind of built a company out of this, so it's been very helpful having our employees kind of help leverage their skill sets to kind of help expand this company even further.
Well, I think that you guys have done a lot of great things. I think you've done a great job with branding. I think you've done a great job with process management. I think you've done a great job with having different verticals within the company. So I guess first talk about, you started in Phoenix, and I believe you grew to be either the largest buyer in Phoenix or one of the largest buyers in Phoenix. So maybe talk about that. And then you recently came to Dallas, and you're on your, I think, 4th purchase in Dallas. Why'd you pick Dallas out of every place else, and why'd you decide to go outside of Phoenix?
Yeah, great questions there, Darin. So, in Phoenix, excuse me, we started initially, our entire plan was to do value add multifamily. So the first deal that I went into as a general partner was a 36 unit deal. We bought that in February of 2019. Zach and Robert had already had the deal under contract, and they just needed, an extra capital for the deal. I wanted to be a GP. So, this was the first deal where it was just our money. We didn't have any syndication going on there. there. So we kind of put all our money into the deal, kind of learned the ins and outs of how the deal worked itself and how the back office worked, the asset management worked, how the business plan kind of worked. And once we were comfortable with how, our business plan and our strategy was going to work, we decided to start venturing out and start doing syndications. So, at the time, Zach had his own brand, I had my own, and Robert had his own. So we were kind of like, quote unquote, dating each other for these different deals. By the end of the year, we really kind of realized that our skill sets were very complementary. Zach is, he's the face of the company. He's great with building relationships with the brokers, building partnerships with capital equity providers. I am the worst with that. I cannot save myself in a conversation for longer than 30 seconds. He's, but
this conversation is going to be longer than 30 seconds. I guarantee
when you get me talking about myself, it's really easy. He's great at, being the relationship guy, but he hates Excel. He hates everything related to numbers, essentially. So that's where I come in. My skill set is underwriting, asset management, making sure we're, from a paper perspective, running through our business plan and hitting the numbers that we need to. And then, Robert, he's great on the field, making sure that when we're renovating and doing our, business plan execution, that we're putting in the right materials and it's going in accordance with our plan. So, we kind of complemented our skill sets across the board. And by the beginning of 2020, we had just kind of said, let's just get rid of our personal brands and kind of work together as partners in this joint venture called, at the time we called it Summit Equity, but then, there was another Summit Equity in Arizona that there was some confusion. So we rebranded to Rise 48 Equity. Since we rebranded, we've acquired over, I would say like 30 plus deals in Phoenix, and across the entire spectrum, we've been the general partners. We identify the deal, we get all the equity lined up, we run the deals, and at the beginning, we hired third-party property management to do the basic day-to-day, operations of the deal. And in 2019, we actually had our property manager do the construction management as well. Quickly kind of realized that having the property manager do construction management was not ideal. And as an example, one of the deals we bought in August of 19, we had our property management oversee the exterior paint. And that's not a huge, overkill in terms of renovations or overseeing construction. That took them 6 months to
6 months?
6 months to just put the paint on the exterior. And we were just shell shocked. We're like, hey, this does not take this long to do this. Like, you guys need to be on the vendor, making sure they're doing their work. And we just kept getting the runaround. So in 2020, when we were kind of expanding a little bit more, we just said, you know what, we're going to bring all this in-house from the construction side. So we brought construction management in-house, where when we were doing exterior paint or doing, any sort of exterior renovations, Robert would essentially go and oversee it. And in 2021, we hired our director of asset management, kind of gave her the ropes on kind of overseeing CapEx management. And she basically, took that 6-month timeline down to about 45 days.
Wow.
So the moment we take over an asset, we have a vendor ready to go. And within 45 days, we've essentially rebranded the asset and have put the exterior paint on, so that now it's a brand new asset after we've kind of taken over. And then that was just exterior paint. Like interior renovations, I can't begin to tell you, like, the deals that we were doing, like, we would get budgets from our property manager saying, hey, it's going to cost $6,000 or $9,000 a door to renovate. Right after we take over the property, it's like it changes completely. Like, it goes like, hey, it's actually going to cost around 15 to 20K a door. Like, we underbid it accidentally, but hey, this is the new price, take it or leave it. So we were just getting the runaround for even on the interior renovation. So in 2021, when we took that over, we made sure we were accurately bidding out interior renovations, exterior renovations to kind of dial in our budgets. So that was essentially the next step that we did. Was we started with the equity company, brought construction management in-house, And then towards the end of 2021, we brought property management in-house. And that was primarily because of the situation that we're in and the economic environment that we're in. We're at 3.7% unemployment right now. So it's essentially really tough to get good employees at the properties. And our third-party PM was essentially not taking care of their employees. We were losing good property managers, good leasing consultants on site, because at the time that PM was not offering any benefits, and they were not offering any sort of training for their on-sites. So they would come on and a month later just leave, essentially, because they've been kind of left out there to dry. So we brought property management in-house at the tail end of 2021, and in 2022 really kind of honed in and established the processes of running a management company, a construction company, and an equity company all at once. And then by the end of 2022, we were in a situation where we're like, okay, well, now that we have the business model established, we can now replicate this in other markets. So we started looking at different markets like Dallas, Tampa, Utah, Idaho. And, Dallas has always been a market we were interested in. We just never liked, having to deal with property taxes that may go up by 20-30% in a year, right, or insurance that may be ridiculously expensive. But we found some good partners to kind of understand how property taxes work in Dallas, how we can underwrite insurance a little bit more accurately on the front end. So Dallas, from a metrics perspective, it has really strong job growth, really strong population growth, which are really the two key fundamentals to look at when you're looking at multifamily investing. And we figured, hey, now's the time to kind of attack. So at the end of 2022, beginning 2023, we started hitting the market really hard and started identifying deals we wanted to buy. And that's how we kind of took the framework we established in Phoenix and moved it over to Dallas and started replicating it out there.
That's huge. You said something that I've done a lot of these interviews, and there are some folks that when they get to a certain size, they do vertical integration and say they have a vertically integrated company, and typically that's bringing property management in-house.
Yep.
A lot of times they're still using, they don't have their own construction arm.
Yep.
You've got the construction arm, you've got the property management, and also under the construction arm, it's my understanding that you also have overseas relationships where you're bringing, materials in at a much
Yep.
more affordable manner to
Yep.
use in the rehabs.
Yep.
But the thing that you said that was different was taking care of employees. That people talk all day long about the value add, and then people complain about the leasing manager leaving, or you didn't talk about the maintenance side, but in my experience, the maintenance people, like, it's hard when you find a good maintenance lead, you do not want to lose that person. Like, they are so good, and they just tend to churn. So taking care of your employees, it may cost a little bit more, but in the end, that saves you so much.
Oh yeah, no, for sure. No, I mean, property management is one thing, but like all our employees, we value them extremely significantly. Like, we have around 90 people on the corporate side now, and about I want to say like 150-ish people on the property management side. And the one thing that we've kind of understood about this entire organization is we're a service organization, and a service organization is nothing without its people. So if you don't treat your employees well, your services that you're going to offer are not going to be they're not going to be the leader in the industry. So every employee that we hire, they get 100% of their medical benefits paid for, and then 50% of their dependents benefits paid for. That's industry leading essentially. If you look at, all the other property management companies, they might offer around 50 to 75% of their employees medical health insurance paid for, and nothing for their dependents, or maybe 10, 25% for their dependents. But we try to, essentially tell our employees that, hey, we're buying workforce housing, apartment complexes, and we're going to need you to grind, essentially. These are not class AA assets built, last year without any issues. You're going to have to essentially take care of the property very well. And the last thing we want you to worry about is having unforeseen medical expenses, or having to worry about, your dependents' medical insurance. So, that was the one thing we identified very early on that was extremely critical to make sure that we identify the right individuals for the properties. And property management in and of itself, the turnover in the industry is very high. So we do go through, and we might have a property manager that starts on Monday, and then next month they're essentially leaving because they found an extra $3,000 somewhere else, and that's fine. We understand that's the business, but we want to make sure that we retain the right employees. So if you're an outstanding employee, and you kick butt on the job responsibilities that you have, we will do whatever we can to retain you. And as having property management in-house is so critical, because if, let's say, we have a leasing consultant that's making $20 an hour, that person finds a job for $23 an hour. If you have a third-party PM, you can only tell them, like, hey, it's okay if you want to increase the budget, please just keep them whatever you can do. And the PM can just say, like, you know what, we're not going to pay more than 20, because then that sets a precedent for the other people.
Right. So
we're going to just let them go.
Right.
When it's in-house, we can just tell that on-site, like, hey, look, we'll match the offer. We like you, want to keep you long-term. We'll pay you $23 an hour. That's perfectly fine. So that's the type of control you cannot get with a third-party PM.
You're so right. I had that happen. Yeah. And I'm going to go back to the maintenance guy. Like, he only wanted like $1 or $2 more an hour, and he was awesome. I had like 4 other maintenance people, and before that, and I'm like, we cannot lose this guy. I'm like, pay him whatever he wants, and but we had a third-party property management company, and they were like, we're not paying him that. And
I know, and it's like
he left, and then next thing you know, we've got a revolving door. Like, people that aren't quality people, that they come for a couple months, and then somebody else comes, and it's like, oh my gosh, that was for $1 or $2 an hour. Like, just bite the bullet.
Right. I know. No, it's hard. I don't know what it is about the third-party PM model that they don't want to do things like that. I mean, I'm sure there's some good third-party PMs out there that, that see this and they understand how to run the business. But, that control was really the reason we brought it in-house. And in order to kind of retain the control and continue to execute our business plan appropriately, we wanted to make sure that we were vertically integrated, where the construction side on the business plan execution definitely was critical for us to make sure we were overseeing the renovations, and we were overseeing all the interior and exterior amenity inputs. And then on the property management side, because we're renovating, 20, anywhere between 5 to 20 units per month per property, those leasing bonuses we're offering and the leasing incentives we're offering, they're appropriately aligned when they get the units renovated and into their rent-ready product, so they can actually get them leased out relatively quickly. So that was critical in order to make sure that our business plan was getting executed appropriately.
That's awesome. I don't know if you experienced this or not. I'm going back to the employee thing because I think it's just so unique. In this business, you typically have syndicators that, maybe it's two people that are partners together, maybe it's 5 partners together, but they're the owners of the property, and they're going to do asset management on top of the third-party property management. But they're the ones that are making the big money. And they're investors, and they many times just look at people, the employees that are on the job, on the property, day in and day out, just as an employee. And I think there's 2 things about that. One is benefits and pay, and people are moving down the road for $1 or $2 or $3 more an hour, but Two is the way you make them feel. You know, it's a tough business, the property management business, you know, and you've got, you know, tenants that you're dealing with, that some of the tenants can be very difficult. And then on top of that, you have the high demands of the property management company and the ownership. So I think that, you know, I'm just thinking, if I'm an employee and I'm with somebody that makes me feel like they care about me, care about my family, then it's going to make me think twice about jumping ship, because that is unique in this industry.
Oh, yeah. Yeah. No, I mean, that's what I kind of picked up. So my background, I used to work at PwC. So I worked there for about 3 years. And, you know, PwC is a huge organization. They have over 200,000 employees there.
I'm a PW alum also.
Oh, nice.
Long time ago.
That's great. Yeah. But did you do audit?
I did audit a long time ago. Yeah.
Yeah. So I was in audit as well. And you know how it is, you know, you're on an audit team, you go out to client by client essentially, and you're basically, you know, every audit team's different. You can have one manager at, you know, client A and then another manager at client B. Well, in my, you know, my second busy season that I was there, I had essentially the best team that I could work with. I love my managers, the seniors that I worked with, and the audit associates that I worked with. We were working, you know, 100+ hours per week on this engagement. And if I got along with everybody, we had a lot of fun, and I didn't think twice about, God, what am I doing with my life? Like, I cannot be working 100-hour weeks here for, you know, 3 months. And that was perfectly fine for me. I was happy. I move over, you know, to the next client over to, that was a private filer, and we only worked around 50 hours a week for that one, less than, or just around half of what the first client was. I could not wait to leave at the end of the day. Like, my manager and I were just not, we didn't see eye to eye. You know, I got my work done, she got her work done, but like, we just could not get along. And like, I was more stressed out working for this other manager, where I was working 50 hours a week, than I was with the manager I was working 110 hours a week. And I always, you know, even like busy season, you know, starts from essentially December to all the way to March, April, depending on the clients you have. And my first client was always this large filer, you know, it's a Fortune 100 company. And I was happy being there. You know, the last year I was there, they had acquired, I want to say 8 other companies, and I was in charge of the acquisitions side of things. So I was reviewing all the 409A valuations, making sure all the work was getting done. And I was there, you know, pretty much one of the first people in and last people out. And, you know, I was coming in at 8 a.m., leaving around 3 a.m., and I was happy. So it sounds crazy, but the manager that I was working with was awesome to work with. They were amazing. And I was a senior at the time, so I had a couple of associates under me. They were amazing to work with. And then I moved over to this other client, again, with this manager that I don't like. And, you know, as a senior, you have a little bit more responsibility, but I was still coming in, leaving, you know, doing around 50 hours a week. And, you know, that's what broke me. That's when I was like, I cannot do this anymore. I essentially left at that point to go in management consulting. And it's really the people, you know. So as long as you work for somebody that makes you feel like you're taken care of and you know, that you're wanted there, that makes a world of a difference.
Yeah, and sharing, you know, sharing the mission, like you guys talked about, like, hey, look, it's not, these properties aren't going to be easy to, you know, we have a lot of work ahead of us, but if you're up for the challenge, we got your back, you know.
Right, exactly.
And I just haven't seen a lot of that in this business. So I think that is best in class, and I want to highlight that for sure. Hey, talk about, you know, in today's market, you know, the transactions are down like 80%, right?
Yeah.
There's people that may say Rise 48 has grown really fast. They haven't been through a recession. They're going into a second market. You know, do they have the controls in place? And do they have, you know, how are they looking at this, and how are they getting deals done when nobody else is getting deals done?
Yeah. No, it's a great question. So, in Phoenix, you don't buy 30 plus assets without making good relationships with the brokerage community, because the brokerage community controls effectively 95% of all the deals that happen that are over 100 plus units. So when we decided that we wanted to go out in Dallas, the market was pretty depressed, essentially. At the tail end of, I would say, Q3, Q4 2022, we kind of figured transaction volume is going to be significantly down based on where the Fed's taking rates. And, a lot of people in, second half of 23, first half of 24 are going to start getting a lot of, there's going to be some distressed sales that are going to happen. So we wanted to kind of get ahead of that. And what we did was Zach had essentially reached out to all the brokers in Phoenix and had them introduce us to their counterparts in Dallas.
Oh, that's great.
Northmark, CB, Marks Millichap, et cetera, they all have their counterparts because they're nationwide brokerage firms. They introduced us to their counterparts in Dallas. We went and actually met with them in person and talked to them about, here's our deal criteria, here's what we're looking at, here's how we're underwriting the deals right now, ask for their input, like what do you think we should change here or there. Obviously, their brokers, they're going to tell you, hey, assume a 5-6% rental increase every year or something. We have our own model. We assume 0% in year one, and then trail back years 2 through 5 around 3 to 5%, depending on the year. And we underwrite conservatively on our end. So basically, what we did was we updated our model to take into account that property taxes are not going to only increase by 2-3% a year. We updated our model to assume that insurance is not going to cost $300 a door. It's going to probably cost between $900 to $1,200 a door, depending on the location and the type of property and the losses that it's experienced. And at that point, we started getting essentially deal flow from these brokers. So, what we experienced was a lot of the deals that they sent over were deals that didn't get done in 2021, 2022. And the pricing that the seller wanted was pricing from 2021, 2022. So, we're underwriting these deals and we're telling the brokers like, hey, based on our underwriting, this deal is like a 2 cap, 1.5 cap. Like, this is not working for us. Like, and we shop all the comps in house. So we're going out, we have a asset management associate out in Dallas. He essentially goes out there and chops the comps for all the properties that we're underwriting. So he'll tell us like, hey, these comparable assets are charging these rents for a unit, one bedroom, 2 bedroom, 3 bedrooms. We're plugging those into our model, and we're just telling the brokers like, look, man, we're like 20-25% off. Like, this is not going to work. And typically what happens is when you're underwriting these deals in a brand new market, the brokers are going to say like, well, this should work at this price because of X, Y, Z. So tell me what you guys are doing so I can help you get there. So what we started doing was, we sent them our model and said like, here you go, here's our entire model, and this deal doesn't work because of X, Y, Z. And if we're doing something wrong, they would immediately give us feedback saying like, hey, the rents that you're assuming are not correct. Like, you should be using these comps or that comps. And we'll take it with a grain of salt and try to see if we can kind of model that in. But majority of the deals that we underwrote, we essentially, when we sent it back to the broker, they basically said, yeah, you're right, it doesn't work. Here's the next deal. So we went in over 160 deals in Dallas by now, and every underwriting takes like 10 to 20 hours. Like, on the Excel side, it might take, I don't know, half an hour to 2 hours to make sure everything's done right. Rent comp shopping takes, by in and of itself, takes almost a day sometimes, because we want to make sure we actually drive the assets and make sure we know what we're looking at. And then when Zach and I kind of sit down, talk about the debt side of things, the equity side of things, on what type of returns to solve for, that takes a little bit of time as well. So we're underwriting these deals and giving back feedback to the brokerage community. And we've underwritten over 160 deals. Around 2% of them have gotten close enough where we can say like, hey, we'll send out an LOI and make this deal work. And thankfully we've won like 4 deals out of all the deals we've underwritten, and and we've acquired those assets. But majority of the assets, I would say on average, we're about 20% away from the purchase price that they want, which is very similar to how we started in Phoenix and how we identified deals in Phoenix. I remember specifically, Villa Serena was the first indication that I did with Zach, Robert, and a couple of the partners. And it took me 45 deals before I identified Villa Serena to go after it. And that was in a market where it wasn't as, competitive, I would say, as 2021, 2022. But that took a while to find that first one. And it's the same situation in Dallas. Like, we have to have aggressive terms, obviously, to get these deals. But, we can execute. So we've put under contract and acquired all the deals that we've put under contract in Dallas, and that's how you kind of build those relationships, and that's how you get the actual deals, not just the deals that didn't sell in 21 or 22.
Yeah, that's huge. I think of today's market, as being more of an off market type of market, where back in the heyday, a year, 2, 3 years ago, it was. You put it out to market and you get 20, 25 offers, and then you go into best and final, and then you go into a second best and final, and like you spend a lot of time and hopefully you win the deal. Today's market, I think of as being like, well, somebody may want to sell. The realistic seller is selling because for one reason or another, they have to get out of the deal, and they don't necessarily want to broadcast it. And so they're like, hey, can you find me a quick buyer that can actually execute? And I'm a believer that you guys are receiving that phone call, and that's why I like to align myself with you guys, because you're getting that phone call where some other people aren't ever getting that phone call.
Right. Yeah, no, track record is extremely critical, right? So the 43 deals that we put 43 deals under contract, we closed 43 deals. And that track record, speaks for itself. And we try to tell the brokers as well, look, this is not our first rodeo. We know what we're doing. We know, for example, terms today, you can potentially get some refundable time, essentially get like an access period or, due diligence period before you go hard on your earnest money. We know what we're doing in terms of underwriting deals with conservative assumptions. So when we put out an offer, we tell the broker, like, we can go hard day one if we need to, because we know that once we go through due diligence, we're not going to be at the numbers we need to for our CapEx, or we need to be at for our for our underwriting, like operational expenses or our rents. I purposely will pare back some of our assumptions for rent growth or just pro forma rents, or I'll pare back or increase our expenses, or I'll increase our CapEx, just to make sure, that if something was to happen during DD, I'm covered. And then from the debt sizing side, we've never been, a very high leverage firm. Our maximum leverage we were taking is 75% LTV. Right now, we're taking around 55 to 60% LTV on our loans because the rates are a little bit high. And if we can make the deal work based on these metrics, then we'll pursue it. But if it doesn't work, we'll just tell the broker, like, hey, the sale's not going to work. Here's the reasons why it doesn't work. Let me know if I'm doing something wrong, but if not, let me know when you have a next deal available.
That's great. I like that approach too. Brokers, they want to build relationships, and they know when they're dealing with somebody that knows what they're doing, right? So I mean, the fact that you're not like just telling them, no, it doesn't work. You're like sharing, like, here's the reason why it doesn't work, and they look at it and they're like, you know what? It's true. Like, on to the next. So you brought up the debt side, and that is, something that a lot of people are talking about, right? So interest rates have gone up dramatically. A lot of multifamily deals, the cash flow has been negatively impacted. There's a lot of deals that have had distributions either cut or stopped altogether. There's been some deals that, have had to go out and do capital calls to bring in additional capital. And and investors are like nervous because they're in other deals that they're seeing this. So when they get in, and they receive an opportunity for a new opportunity, there's some fear there. There's some fear that, hey, one, should we be in fixed rate financing?
Right.
Should we be in long-term fixed rate financing? And so I guess talk about how you guys view the debt side, and how do you mitigate the risk?
Yeah, so the very first deals that we did in Phoenix, they were all fixed rate Freddie Mac loans. I think the first two syndications we did, they were 10-year fixed with 5 years IO. I think the interest rate varied between 3.4 to 3.7%. Great time to do fixed rate financing, or so we were kind of led to believe. Well, 10-year fixed rates come with a significant prepay penalty. Freddie or Fannie call it yield maintenance or defeasance, which basically means, they're essentially telling their investors that if you buy this loan from Fannie or Freddie, this loan's going to pay out 3.7%, and that if this loan is prepaid, they're going to take the money and then invest it in like a treasury bond, where if the treasury bond is paying out less than 3.7%, then the borrower is going to pay a prepay penalty so that Freddie or Fannie can buy more treasury bonds to make up that 3.7% for the next 10 years. So the first two deals, that we did that were fixed rate financed, I can talk about Villa Serena. That one was a $13.1 million loan. We bought that in August and we sold it in November 2021. Well, rates in November 2021 were not so high where you could essentially not have a defeasance penalty. So when we sold the deal, we had to pay a $3 million prepay penalty.
$3 million?
On that loan. Yep.
Holy cow.
26% of the loan amount as a prepay penalty on that loan when we sold it. Now, fixed rate financing is great when you want to hold a deal for 5 to 7 to 10 years. It's a perfect product for that. And when you're not doing value add, when you're not looking at that appreciation, it's a perfect product. I have nothing against it. I think it's a great product. But, our company does value add strategy. The whole point of a value add strategy is you're going to infuse CapEx into the deal. You're going to increase the NOI. Sure, that's going to unlock some of the, cash flow for the investors, but you're really after the appreciation play. You can get maybe 30 to 40% of cash flow from your total returns, but 60 to 70% of the total profits are built into that sale. So when you put on fixed rate financing with a significant reliance on increasing NOI to increase the value of the property, well, you don't want to lock yourself in for 5 to 7 years because you want to be able to take that equity out. And you can take supplementals, to kind of to refinance, take a supplemental and just continue cash flowing. That's a great way to do it. But the other aspect of fixed rate financing through agency is that they do not fund your CapEx. So you're raising all that money up front, and then you're going to be holding in the property's bank account, and then you're going to slowly, pay it out to pay for the capital expenditures to renovate the asset. So the other thing we kind of realized with those two deals that we had done was, okay, well, we're raising $4 million for the down payment, raising $2 million for the CapEx, and that $2 million is going to just sit in the property's bank account, earn 0.05% interest, and I have to pay out, a 14-15% IRR on that $2 million that's sitting in the bank. That doesn't help the deals at all, and it doesn't help me execute my plan to be able to sell within 2 to 5 years. So that's when we kind of switched over from fixed rate financing to floating rate, because floating rate does not have those prepay penalties. I can, with the agency floating rate, you can you have a 12-month lockout, then you have a 1% exit fee. That's all it is. And the deals like Villa Serena, where we sold for a great equity multiple, essentially could have gotten extra 50 to 75% in profits for our investors if we didn't have to pay that prepay penalty. So that's when that's why we think doing floating rate loans is better for the long term for value add strategies, because you're really kind of looking for that appreciation play to kind of unlock the majority of the profits for investors.
So I get that.
Yep.
Now, agency versus non-agency. So I know I'm in some deals like this, and I know a lot of other syndicators that are in deals like this where they have agency floaters, but they with a cap, but then they're required to, once they get to a year out from having their cap expiring, they're having to escrow. And so the escrow for a new cap is killing the cash flow on a lot of deals.
Yep.
So how do you look at that?
Yeah, no, that's definitely a great question. So right now, the environment that we're in, the interest rates, if the yield curve is inverted, you have, 1 month SOFR at around 5.05, whereas the 10-year treasury is at 3.7%. Normally, you would see the 1 year or the 1 month SOFR around 2%, 1 to 2% is where the baseline would be. Whereas, the 10-year treasury should be around 3 to 4% on that end. So that's a normal strategy. So what's happening is, all these interest rate cap providers, they're basically increasing the price of their cap costs because they see that they're going to have to pay the interest on the loan, because the cap that you're going to buy is going to be around 2.5%, whereas the floating rate debt is basing it off of 5%. So they're building that in, which is causing these cap costs to increase significantly. Now, we don't do agency floaters anymore. We used to do that, but I think the reason we moved away from it was primarily because, again, we had to raise the CapEx as equity, leave it in the bank account, and then just kind of slowly deploy it out. We do bridge debt financing now, where we don't have to do an escrow reserve for those caps that expire, and that's because we've bought every single bridge debt that we've done. We do essentially a 3+1+1 term, which basically means it's a 36-month term plus 2 1-year extensions. And we've always bought 3-year caps for every single deal. So what happens there is, from a bridge debt perspective or the lender perspective, the term is 3 years, and you've bought the cap for 3 years. That means you don't have to escrow anything from the lender perspective. If I was to execute if I was to execute one of the extensions, I would have to, at that point, buy another interest rate cap at that point. So that's the way, we're protected from a cash flow basis, that they're not escrowing any funds, because we didn't buy 2-year caps where a third year is going to come up and now we have to pay for an extra year.
Right.
And, we think from the part, our oldest deal that we currently own is as of June 2021. So that deal is going to expire, or that term is going to expire June 2024, and the cap is going to expire in June 2024. So, based on the analysis that we've run, we'll be able to essentially refinance out of that deal we're projecting to refinance out by May of 2024 at the absolute latest. We're probably going to start the process actually in like February, March, but we'll be able to refinance out. And if the market's not doing great and it doesn't make sense to sell, we might put on fixed rate debt on it for 5 years and hold it for another couple of years, as opposed to like a 10-year fixed rate product, or we might just refinance, do a floating rate debt, and then from the proceeds of the loan buy a cap. So our investors don't have to put any additional funds in. We're essentially using the loan to pay for the cap itself, and we're thinking, and we just had a meeting with our debt brokers yesterday, and they're thinking as well, the rates are probably going to start coming down beginning of next year at the absolute latest, assuming inflation starts trickling down a little bit. And then as rates come down, your cap is not going to cost as much, and you can use proceeds from a loan to essentially pay for the cap. So I know it's short term. A lot of investors are kind of seeing their deals, their escrows essentially go from like, $2,000 a month to like 20, 30, 40, 50,000 a month.
It's not like 10 and 20%. It's like,
it's like 1,000%.
Yeah, exactly. And people that are not in the business, but they're investors, they're like, holy cow. And it looks like it's gone, but it really it's like in an escrow account. and the sponsor may end up having to buy that cap, when it expires, or may not, or they may refi, or they may sell. Like there's a lot of unknowns as to how that money is going to be used.
Yeah. Yep. No, thankfully, it is in an escrow account. So when you do sell, you'll get the money back, assuming you haven't had a need to buy the cap. So it's short-term pain, which I think a lot of sponsors and investors are feeling. But thankfully, it's just a hedge against buying a cap in the future as an escrow today. So and some deals that we've acquired in Dallas, one of the deals we acquired it was exactly in that situation. They had a Freddie floater in place, and their escrow went from $8,000 a month to $92,000 a month because of the cap. And as an investor, and I think it was under a TIC ownership essentially, but as an investor, their cash flow got decimated.
Right.
They were making no money from the deal, and they essentially said, you know what, we might as well sell. We don't want to buy another cap, hold it for an extra 2-3 years, and try to sell later on. So they decided to sell. We bought it, and now they can free up that capital to go after another deal that'll actually cash flow. So, and the other part, the worst part of this for some investors is there's sometimes not enough NOI to cover the escrow. So, the deal may be cash flowing perfectly fine, but when your escrow goes from $8,000 to $92,000 for just a cap.
Yeah.
If the deal's not making that extra, $74,000 a month or something, then you're going to have to do a capital call to fund those reserves, which is not a situation you want to be in as a sponsor.
Right. Exactly. So talk about in the news, there's a lot of press about rent stalling out. And from what I can see, it's from the deals that I'm in and talking to people, it's the top line rent growth. Like you can't just have an apartment and raise the rent by 5% or 10% or 15% and not do anything. But there still are apartments that are below market that if you improve them, you could bring them up to market. And that's kind of the game plan that you guys are focused on. Is that correct?
Exactly. Yep. So the way we look at rent growth, we're kind of looking at it from like a trend perspective, right? So in the past 20 years, Phoenix has consistently, on average, grown about 5 to 6% a year. That's facts based on RealPage, and that's what we've seen in our market. And unfortunately for Phoenix, that rent growth tends to go skyrocket in a couple of years, and then it comes down pretty fast in the next year or so. So, the past 2 years, rents have gone up around between 15 to 25% a year for Phoenix. And this year, I think as the latest data from RealPage, rents have gone down around 4%. So, but if you average those out, Phoenix is still leading the nation in total rent growth for that top line rent growth. Well, when we underwrite, we're not underwriting 10 to 15% increases in rent growth. We're underwriting between 3 to 5% on average for the rent growth for years 1 through 5. And, on a stabilized basis, if you look at the 5-year horizon at a time, you're going to see that in Phoenix. And you're exactly right.
California, right?
Yeah. Well, I moved to Phoenix April of 21.
Okay.
Yeah. Yep. But we've always underwritten between 3 to 5% in our deals, and what we've kind of seen from our market is that because we're buying value add, we're renovating these properties and renovating the interiors at about $15,000 to $16,000 a door. We're putting in brand new quartz countertops, stainless steel appliances, vinyl plank flooring, interior paint, LED fixtures, plumbing fixtures, etc. And because we're putting such heavy capex into the deals, we're essentially standing out for potential tenants. So when they compare us to an existing asset, they're seeing like a Class A finish in an 80s product versus, Formica counters or resurface counters on a comparable property. And it's making it easier for us to keep and retain our tenants and get new tenants into that building. And you're exactly right. Rents have kind of stalled and gone down, but that's top line rent growth.
Right.
What we're seeing based on our underwriting, we're increasing rents around $29 above what we projected rents to be at right now for our deals. So if we bought a deal in 2021, we assumed, say, $1,000 a unit for rent growth, or sorry, for rents at that point. We also assumed rent growth or market rent growth in 2021, 2022, 2023. In 2023, that $1,000 might be now $1,095. Well, we're getting $29 above that $1,095. So we're getting the rents that we need. Now, the market as a whole has been a little bit depressed. So we're offering concessions because everybody else in the market's offering concessions. And from a tenant perspective, if you're not offering concessions, it's automatically, they're not going to visit the site. So in order to kind of entice people to come in and look at the property, look at the product, we're offering concessions for those tenants, but we're getting the rents that we need from a top line basis based on our underwriting for these deals.
Yeah, that's cool. Talk about momentum. And when I talk about momentum, more like velocity of money. So
yeah.
you're implementing these value add. One of the things I've been impressed with, obviously you guys were in a great market with tailwinds behind you. You were in the number one rent growth market and a cap rate compression market. But you were turning deals faster than a lot of other syndicators would.
Yep.
Other syndicators would maybe wait 3 or 4 years. Maybe you guys were turning deals in a year and a half, 2 years, and then people would have the money and then they could reinvest that. So kind of talk about that velocity of money versus a buy and hold strategy, and then maybe tie in the fact that because there's taxes involved on a sale versus a buy and hold. But you guys also offer 1031 exchange kind of rollover. So talk about all that.
Yeah, of course. So, from our perspective, what our investors want are consistent returns over, like if we're doing a 5-year projection for our investors, we're typically assuming that we're going to get to around doubling their money in about 5 years. It depends deal by deal, but that's kind of like what we solve to for our underwriting, and that translates to around 20% average annual returns. Well, internally, we've kind of decided that, hey, if we can give an investor 20 to 30% average annual returns over, say, 2 years or, 3 years, which is like a 1.4 to 1.6 equity multiple, well, we'll do that essentially, because that's still beating the market. That's still making sure that we're giving outsized return to our investors. But it's going to, again, vary deal by deal, and every deal is going to be different. But internally, we've essentially established that if we can get to a good return for our investors before the 5-year horizon is up, we're going to go ahead and sell the deal. And that's exactly what happened in the past. The 11 deals we've sold, our average hold period was around 18 months, and we've given outsized returns to our investors for those deals. I think the average, equity multiple was around 2.1 for those 18 months. Now, as you mentioned, we're in the top market in the nation, tailwinds behind us, and we took advantage of the market. We don't try to get greedy and say, hey, if I can just wait for another year, I can get to a 3x or a 4x equity multiple. It's always been, if we can get to a good return, we have our essentially floor that we've established, and if we can hit that floor, as long as we don't trigger any short-term capital gains taxes, we're going to go ahead and execute the sale. So we're going to buy, reposition, and sell essentially as fast as possible. And it kind of goes back to my point earlier where I said, a lot of the equity is locked in to that profit at the end. So you don't want to end up cash flowing the deal 6% a year, 7% a year, and then get 50% after 10 years. If I can give you 6% in the first year and then give you 50% in the second year, I would think that an investor would want that more so than waiting 5-6 years on that consistent cash flow.
Right.
And then the second thing about taxes, we offer 1031 exchanges for investors. So what we do is we'll sell the first deal and then exchange the proceeds from that deal into the next deal that we've identified as a good replacement asset. That way it may help investors defer their capital gains taxes and depreciation recapture taxes. And then investors who do want to cash out and don't want to be part of that process, we redeem them from the partnership at the sale price. So assuming that we had essentially sold the deal, we would give them their initial capital plus the profits on sale at that point. So, and we've worked with a couple tax attorneys to make sure we've done the process appropriately. It's clear in the eyes of the IRS, but every investor is different. Their tax strategy is different, so they should talk to their tax advisors to kind of identify the right way to kind of participate in these deals or not. But we know that capital gains taxes are crucial to kind of look at, and depreciation recapture taxes are also crucial as well. So we want to help investors kind of preserve their capital and preserve their growth of their capital, and that's why we offer that 1031 exchange program across our deals. Whenever we sell, we always try to look for that replacement asset for our investors.
Awesome. Do you think today is a good time to buy?
I think every time in any market, it's not when you get into the market, it's how long you're in the market, right? You can say that you can make the same argument for stocks, bonds, alternative investments. I don't know if you can make the argument for crypto, but for real estate, it's always been a buy and hold strategy, or buy and essentially you can hold it for a year, 2 years, 10 years. Depending on the market cycle, you're going to make money on real estate. So the deals we're buying right now, actually the deals that only work for us right now are the ones where the seller has to sell. If we're not sellers right now because we know the market's down. The market's down anywhere between 20 to 30% versus where it was at last year. And I would say right now pricing for the market is around where it was around, I would say Q2 of 2021. So if I was to sell a deal today, I would essentially be offering a hefty discount for a buyer. And I'm not in a position to do that, so I would not sell anything. But as a buyer, I am actively looking for deals that a seller has to get rid of. And if that deal works for me, I know I'm getting a discount today. And I know that in 2-3 years, when the market is back in some form or fashion, because we are in a cycle, that cycle is going to come back. And I've never seen a recession last longer than 2 years before the market starts coming back and starts getting heated up again. If I'm buying deals today, I know in 2-3 years, even if I don't do anything to the property, I'm probably going to make out all right in 2025, 2026. That's just a reality. And, thankfully we don't buy, 2022 bills where we're only waiting for, market appreciation to take the property to the next level. We're doing value add strategies. So regardless of what the market's doing, we're going to go in, renovate the asset, renovate the property so that we can increase the cash flow. And if the market's back in 25, 26, we'll sell it. If not, we'll refinance and hold it for a longer period of time. So I think anytime is a good time to buy. You just want to make sure you're not becoming too aggressive on your underwriting methodology.
Yeah, and I think that, so you guys, if you look at deals that are in your portfolio versus new deals that you're looking at, well, deals in the portfolio, nobody could have known that the Fed was going to raise rates that fast, that quickly in that short period of time. But we're there now. So, you have that information. So you're underwriting to today's interest rates, and today's market. And just as, inflation could continue and rates could continue to go up, the opposite could happen too, where rates could drop and that's what more people are saying, that next year the rates will drop. Who knows what will happen? But if that was to happen, then that would be a benefit because that would increase the cash flow. So
exactly.
In any event, anything else that we didn't talk about that you think that investors need to pay attention to and consider? I think that some investors are saying, well, I can get 4 or 5% in a bank today.
Yeah.
And so why am I going to do a multifamily deal? I've got all these multifamily deals where everybody's in cash flow problems. So
yeah. No, we've heard that too. I think the one thing that investors should, be wary of is that 4 or 5% is not a consistent 4 or 5% for the next 10 years. Right now, you're getting 4% or 5% through a money market account because the rates are at 5%. Tomorrow or next year or the year after, when the Fed starts decreasing the rates, your 5% is going to become 4%, 3%, 2%, and then finally go back to where it was a year ago.
And then they call and say, I want to get into your deals again.
Exactly.
And then at that point, the basis is higher in all the deals.
Right.
And, so
it's back to the market's too high. Like, doesn't make sense. So I'm not going to do it. So
it's hard.
No, we've heard it before. Yeah. And the other thing is, you're not going to get any sort of, appreciation on a treasury bond. You're going to get your 5% a year, and then you're going to get your money back at the end of the year, and that's it, or at the whenever the term expires. Well, when you're investing in multifamily or investing in a sponsor, depending on the way they kind of structure their deals, you're getting that cash flow of 4 to 5% today, and then you're getting that profit at the end when you sell the deal. So that's significant portion of the the capital. There is risk involved. Obviously, it is an investment. So you want to make sure you are doing your due diligence on the property, on the sponsor, their track record, etc. But it's not an apples to apples comparison when you're looking at treasury bonds versus real estate investment. It's the same. You can make the same argument that, hey, what's stopping me from just taking all my money out of the stock market and putting into treasury bonds? Well, sure, this next month you're going to get 5%, but if the Fed drops rates tomorrow, that 5% goes away, and then you go back into the stocks and equity, but now you're coming in at a higher basis because all the investors just did the same thing.
Right. That when the market dropped, people got scared and they took their money out, and then they say it's the wall of worry, right? The stock market continues to rise, the valuations, and everybody's on the sidelines. But hey, I appreciate you coming on. I appreciate the relationship. I appreciate being able to work with you guys. I think you guys have built a fantastic machine, and how can people reach out to you if they want to get to know you better and rise better?
Yeah, no, investors can go to rise48equity.com. There's, on there's a click, you can click on a link to kind of set up a call with Zach, Robert, or myself, and then we can talk, we can talk personally, kind of understand the investor and see what they're looking to invest in, and, potentially get them on our investor list so they can see our opportunities in the future. But yeah, no, that's the best way to reach out to me, or you can email me directly, Bikran@rise48equity.com, or find me on LinkedIn. I'm happy to connect and kind of explain what Rise 48 does, and if it's a good relationship, we can potentially, work on a deal together later on. But it's great having you as a partner, Darin, on our deals, and we appreciate everything you do as well. So
I appreciate it. I mean, look, it's nice doing business with good guys that are buttoned down in the business. So that's my take, at least. So keep it up.
Thank you so much. No, thanks so much, Darin.
Hey, listeners, until next week, signing off.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you, and please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.